Hi, everybody. Welcome back to the Comstock channel. I'm Marlin Bowling with you. Glad you could join us today. And just right off the top, just a little reminder, make sure that you like this video and click on that little bell icon down below so you can be subscribed. We'll let you know when we have new episodes that come out. And be sure and share this video with others as well. Well, my special guest today is Tanner Ehmke. He's with CoBank. He's based in the Denver area. And Tanner, thank you for coming on board here. I guess I didn't know it at the time when we lined up the interview. You and I are both Kansas natives. So you came from the western part of the state. I think we both had pretty circuitous routes to get to where we are right now. But it's interesting that now you're working with CoBank. And I'm sure you probably have a keen interest about what's going on with the ag economy, especially in the plains. So how is it holding up now? I know you've been going through about 4 years of drought out there.
Yeah, we've had a little bit of a reprieve somewhat over the winter because we were still in El Nino at the time. We're now fading out of El Nino, unfortunately, and going into La Nina. And that tends to be drier on the plains, hotter and drier on the plains. I don't think that's going to we'll have a full La Nina in effect until about maybe June, at which point the wheat harvest will be well underway. So we've had a bit of a reprieve, though. It's still a little dry across the state of Kansas in the plains. USDA had come out with their crop conditions report on Monday, showing that conditions had dropped a point. I think we're now about 55% good to excellent. And so although we're going backwards a touch and there is still some dryness on the plains, it's a remarkable improvement compared to where we were last year, where we had severe drought all over the region. It's not quite as bad this time around, and we're going into the growing season of the vegetative state now in a much better position. There was a fair amount of moisture over the winter with some big heavy snows that were greatly needed. So I'd say things are improved crop-wise, but we're not out of the woods yet. We never are. As they say in Kansas, either you're just coming out of a drought or you're going into one.
That's about right.
I think we're in that in-between zone right now.
I have multiple relatives that are in the ag lending realm. And I have to tell you, boy, heading into 2024's growing season here, you have got your work cut out for you this year. It's going to be a challenge to get everybody to turn a profit this year.
Commodity prices across the board in agriculture, at any way, are down for numerous reasons. We've got supply abundance around the world for corn, soybeans, and wheat. And of course, we have a strong dollar. And that combination is a dangerous combination for agriculture. We have to compete against South America's record crops. We have to compete against the Black Sea region, mainly Ukraine and Russia. And so those factors combined are some real headwinds. And then you throw a strong dollar on top of it. And there's just no good story there. When you look at the agricultural commodity markets versus the other commodities, like metals, industrial metals, or precious metals like gold is record high right now, or energy, crude oil prices are climbing. Where's agriculture in this? Why is agriculture missing out on the climb in the commodity sector? Well, it's because the supply-demand fundamentals are not working towards that bullish story because, again, we've got supply abundance, and then you throw a strong dollar on top, and it's just hard to compete. So, it's going to be harder to turn a profit. I was reading the report from the Kansas City Federal Reserve on their surveys of community banks that lending is up. We're seeing that in farm credit lending is ticking upward. There's more interest now that farm margins are being compressed because of not just lower commodity prices, but costs are still fairly resilient. Your land rents are still fairly high. Machinery costs are still fairly high. And so as a result, there's just a hard story there, or a difficult story in terms of margin, where commodity prices have come down, but the costs have not. And so that's obviously going to put a lot of farmers in an unideal situation on their margins.
Well, of course, we had several years of record income on the farms. I mean, had a good 2 or 3 years going there. Yesterday, this past year, not so much. But if that's the case, I'm just wondering, are the operating loans really much larger this year just because they don't have the money to draw on after last year?
Well, as a whole, when you look at the economy as the ag economy as a whole, we had record net farm income 2 years ago. Last year was down some, but it was still historically high. And now USDA is expecting net farm income to be down 25% this year compared to last year. But when you look at total net farm income over history, this is still the fourth highest year. I know that's hard to believe but we're coming off of a very, very high watermark that is not sustainable. And anybody who's been around for a time in agriculture knows about the cycles. They saw this coming. This is not a surprise to see net farm income dropping. Any farmer that's farmed more than a couple of decades knows about this. So they're not being caught flat-footed. And what they've probably done, if they were smart, is they paid down some of their debt. They renewed their machinery line. They took advantage of the incomes that they had that were record high or strong, if it wasn't record high on their specific farm, and they reinvested it. And so, yeah, it's absolutely going to be a tighter situation for most people. But I think if they were smart and they got a track record behind them and of having worked through many cycles in agriculture, they saw this coming and they were prepared. That being said, there's a lot of people who weren't prepared, unfortunately. And so we're going to have to keep an eye on the Chapter 12 bankruptcies. We're going to keep an eye on the non-accruals, those kind of things. And invariably, there will be some farmers who are stressed.
So in general, how do interest rates on operating notes compared to what they were a year ago at this time?
Well, they're absolutely higher. When you look at the interest rates on a farm operating loan, those are typically variable rates. They're going to follow very closely to what the Federal Reserve is doing. And so as the Federal Reserve, as we all know, has increased interest rates over the past year and a half, 2 years, we've seen as a result the interest expense on the farm climb as well. So it depends upon who you're banking with or whatever institution you're with and what region you're in. All of that matters. But you're looking at an operating line or operating note with a variable rate of something like 7 or 8%, sometimes 9% thereabouts. That's if you look at the curve, that follows right along with what's going on with the Federal Reserve. The Federal Reserve has announced or did announce back in December that they wanted to cut rates 3 times this year. That would have been great for the farmer. Unfortunately, this week, well, not unfortunately, it just is the fact that Jay Powell, the chairman of the Fed, has said that that may not happen, given that inflation is still fairly resilient. The last inflation print was fairly high. And so the Federal Reserve is very cautious about this, that perhaps they may not have the room to do that anymore. So perhaps we will not see the reprieve on borrowing costs that some had been anticipating.
To almost no one's surprise, too, I might add. How about land interest rates? Have they changed that much?
I haven't looked at the Federal Reserve data yet or talked with anyone else in the Farm Credit on land here recently, but I would assume that's going to be following closely as well. Those are probably going to be fixed rates, obviously. So therefore, it's probably going to be at a lower rate. But I think that if rates do come down with the Federal Reserve, then the borrowing costs on land are going to come down as well. But that's one of the reasons I think that one of the many reasons why we're anticipating a peak in land values this year. The main reason is because of net farm income coming down 25% this year. Farmers just aren't going to have the cash to be spending on land this year, and our anticipation is that we're going to see land values probably start to drop at least by 2025, perhaps this year even in some areas. But I'd say that's the path we're going to be on as long as interest rates, as you point out, remain fairly resilient and net farm income continues to decline. That's going to be that's going to put downward pressure on land values.
But so far, they're holding up there pretty well, you said.
They've been fairly resilient, but remember, as we talked about, farmers are carrying over a lot of cash from the last 2 years of record and near record farm income. Working capital is high, or fairly high. The working capital is starting to come down because remember, working capital is cash or anything else easily converted into cash, like grain sitting in a grain bin. Well, what's happened to the price of grain over the past year. It hasn't gone up. And that means your working capital has not gone up. It's gone down. The value of the grain that you could sell for it to convert into cash is a lot lower than it is now. So because of the decline in working capital, the money just isn't going to be there to support sustained land values, over the course of the next year.
So, what do you see as the biggest challenge for farmers this year when it comes to looking at it from the economic standpoint, anyway?
It's all going to be about cost. Markets are going to do what they do. A farmer can do the best job they can at marketing, and that's important. Marketing is absolutely important. You got to know what your cost of production is and your break even, so you know what a profitable sale point is. And we always have to remember the market has always delivered a profitable price. It just may be very, very short period of time, but that opportunity is always there to make money on the farm. So really here, the question is going to be about how nimble you are in the marketing, but on the cost side, that's going to be the stickier point. How can you lower your costs? And, that's really going to be about, can you renegotiate your cash rents? Can you do other thing? Can you work with your banker on on your debt, your interest rates, things like that? All of that comes into play about what your total cash or what your total costs are, because you're going to have to lower the cost, and one of the fastest ways to lower your per unit cost is obviously higher yields. So pray for good weather. That's, I would say, is the other cost component. Is hopefully you can get some favorable weather and to boost your yields, and that lowers your per unit cost of production.
And I guess it would be understandable. I have heard that some of the highest demand is for good used equipment right now because of that.
Absolutely, that's what I've been hearing as well. Used equipment is hot. The new machines today are just so expensive. And trying to justify that expense when at today's commodity prices, you can't. You just can't do it. Plus, the machines today are very technologically advanced, meaning a lot of farmers aren't able to work on it themselves. They got to take it into the dealership where they charge however much money, $100, $200 an hour or whatever, per hour to plug it into the computer. Those are high costs. And so, used machinery that is less technologically advanced can save a lot of costs, not just on the purchase price of the machine, but also perhaps on the maintenance costs.
Because of all these high costs, it's really hard for young folks to get into farming now. Unless you have like a rich dad or grandpa or uncle or something to get you started.
Yep.
Are there any avenues that maybe some young farmers can look at for a little help to get started nowadays?
Right. Well, that's a great question, Marlon. I'd say USDA has got a number of young farmer programs. So you want to definitely check with your local USDA office, the FSA office, to see what they have. I know they have low interest loans, things of that nature to help young farmers get started. Of course, it always helps when the young farmer brings their own money to the table. So probably what that would imply is you've got an off-farm job or a prior career, and so that always helps. If you can maintain that off-farm job to maintain your cash flow during that period of startup, that's always handy.
All right, I'm going to turn the table on you here a little bit. So we've been talking about the economy from the farmer's standpoint and what kind of position they're in. How healthy are the ag banks right now?
Very strong. Farmer balance sheets, for the most part, yeah. I mean, well, loan volume has come down over the last couple of years because farmers didn't need loans; they were making so much money, and so loan volume has been impacted. There's no doubt. But I'd say, given that land values are so strong and the net worth of farmers is very strong, we're not. There's no sign whatsoever that we'd see anything like a repeat of the 1980s, where the collateral or land values had dropped suddenly. And that's what got so many banks in trouble in the 1980s was the collateral that the farmer had dropped so fast, and that's what caused so many bank foreclosures. We're not anywhere close to that right now. Land values are strong, and balance sheets are fairly strong. And so as a result, the banks don't have that concern. The only concern, though, has been the drop in loan volume over the past couple of years. That has hurt a number of banks. But based on what I'm seeing right now and hearing, that's starting to turn a corner. Farmers are coming back to their lender, needing some financial help with low commodity prices. So I'd say from the financial perspective, or from the banker perspective, loan volume appears to be picking back up again.
Well, that being said, do you have certain areas of the country that are under a lot more agricultural financial stress, in the banks and the farm system out there, than other areas of the country right now?
The plains had a terrible drought last year. And it's hard to grow a crop when it doesn't rain. And so I think that place, the plains generally, has had the more stressed environment over the last couple of years. And, dairy is also going through, some lower prices. Across the board right now, really, we're seeing, the effects of lower commodity prices. Grains, dairy. The only exception would be cattle. Cattle prices have done very well. And then you've got a number of other one-off crops. Cotton is doing very well. Rice has done phenomenally well. So I don't mean to paint a dire picture, Marlon, about the entire ag economy. There's a lot of farmers out there who are going to do okay because their commodity prices are doing all right. Like I mentioned, cotton and rice and cattle. Hogs even have picked up. So I wouldn't say it's a complete down and out picture. I would say it's mostly focused on the issues of corn, wheat, and beans right now. Not a good situation there for most farmers.
So it sounds like farmers and ranchers actually deserve a big old pat on the back for weathering the storm so far, huh?
There's always a storm, and as you know, in agriculture, it takes a certain type of person to farm and ranch and make a living at it. And yeah, that's an extraordinarily difficult job for so few people to do. I mean, less than 2% of the country is feeding the rest of the country and the world. Yeah, there's a trophy there, I suppose, for making that happen with all the challenges that come with agriculture, especially with weather and markets.
Yeah, well, Tanner, thank you. I enjoyed talking with you, and thank you for the update on how things are doing in the ag economy these days and the banking economy as well. Hopefully we can touch base a little later on and get an update. Let's hope that this growing season progresses pretty well on the benefit of everybody out there. But thanks again. I'll talk to you soon, all right?
I appreciate it. Thanks for having me.
Tanner Ehmke of CoBank with us from the Denver area. And that's going to do it for this episode. Appreciate you joining us. For producer Brianne Hendrickson, I'm Marlin Bowling. We'll catch you next time on the Comstock Channel. Thanks for joining us on our Comstock YouTube channel. Don't forget you can also find us on Facebook and TikTok as well. Futures trading involves risk. The risk of loss in trading futures and or options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.